With this, we can move on now to the next session, which is going to be chaired by Mr. Orestis Chontoulidis. Orestis is partner within EY's Financial Services and Risk Management, and he has a rich experience on how banks can integrate ESG criteria in their operations, how to quantify ESG risks, and stress testing. So, Mr. Chontoulidis, the screen is yours.
Thank you very much, Professor, and good afternoon, everyone. I hope you can hear me well. It's really exciting to be here and have the chance to chair this session, in which the speakers will talk about sustainability, trends, and challenges. Sustainability matters are increasingly at the top of the agenda of regulatory bodies, supervisory authorities, financial sector entities, and the broader corporate world, as well as the academia. And I'm delighted with the diverse backgrounds of the speakers in the session, who will share very interesting insights from different perspectives. Without further delay, please allow me to introduce the first speaker, Ms. Kristina Church. Ms. Church joined the Bank of New York Mellon Investment Management as its global head of responsible strategy in 2021. Before this, she had undertaken the roles of head of sustainable solutions and deputy head of sustainability at Lombard Odier Investment Managers. Ms. Church spent a decade at Barclays Capital, latterly in its sustainable and thematic research team. During her time at Barclays, she sat on the Diversity Council and played a key role in managing the graduate intake and mentoring female analysts. She has a Bachelor of Arts in Classical Languages and Literature from Oxford University, UK. I will now pass the microphone to Ms. Church for her presentation. Thank you very much.
Thank you so much, and I hope everyone can hear me well. I will start by first of all sharing my screen, so I hope that you can now see my presentation. So I'm going to talk through a few of the challenges that we're facing for sustainability. This isn't a pitch about BNY Mellon, but I think what we're just trying to show is that the fact that we touch 47 trillion of assets under custody and 1.9 trillion of assets under management does give us a little bit of a unique view into the sustainability environment across multiple asset classes, different geographies, and therefore some of the challenges as well as the opportunities that we can see in the market at the moment. I think I want to start, with there's, 4 key areas I want to cover. I want to talk about some of the regulatory pressures that we're seeing, and you've heard in the previous session around some of that area, but going into some of the complexities of how, as asset managers, and I'm going to talk with an asset management hat on today, although I also sit with at our bank as well as with a preparer hat, but from an asset management point of view, how the different regulations globally and the lack of current interoperability and consistency between them is putting pressure on innovation in the industry and the ability to really move forward in the sustainability space. Also want to look at some of the conflicts that we're seeing. I think for the last couple of years, there was an enormous growth in ESG in the investing world, and it was almost as if there were a lot of commitments, a lot of promises, and we're moving now, I think, more into the reality of delivery, ensuring that everything that is said can be fully backed up. Now, I don't think that, sometimes there's some inflammatory reports in the press that talk about greenwashing or even nowadays green hushing. But the reality is, I think the majority of asset managers are really trying to ensure that the assets that they're managing on behalf of their clients are done so in a sustainable manner for a resilient future and a resilient financial stability. But there are complexities given how fast the environment is evolving, and also how the differences that we see globally. And I think one of the key areas I want to explore a little bit is that within the regulatory environment, the difference between sort of double materiality that is very much understood and beginning to be integrated within European sustainable finance regulations, But in the US, there is a different view, a much more puristic view of financial materiality, and therefore that fiduciary duty. There are some complexities and conflicts in different parts of the world as to how we can really manage the assets of our clients, encompassing both, financial returns, but also returns for environmental and social issues. And of course, there's also client demand, which is shifting fast. We see a huge amount of demand for sustainability within products, but there isn't any fixed terminology now as to exactly what ESG, integrated investing is for one person, may be different to ESG expectations for another client. And we have, some clients who are really expecting ESG integration to be about an input into the financial analysis process, understanding environmental and social issues and encompassing them within financial materiality, but purely as an input into the process. Other clients are really demanding an outcomes-based investing, shifting towards more impact, delivery of environmental and social objectives and outcomes. And it is very important really to ensure exactly a differentiation between those different styles of investing. We all know that climate and increasingly broader environmental issues are a significant risk to the financial stability and financial system. But I think often those risks are talked about in long-term time horizons, 2050, if we're thinking about climate and net zero commitments. But the reality is, as you can see here from the famous World Economic Forum risk survey, is that 80% of the risks seen on a 2-year time horizon, on a short-term investable time horizon, are related to social and environmental issues, and that's only going to increase as time gets further ahead. I think that what's so important about that is that some of the complexities that we're seeing in the political environment, particularly in the US, are calling out whether integrating environmental and social issues into financial analysis is financially material. And it clearly, from a cost perspective, we can see there are significant risks to the short term, but we also see this as significant opportunities too, and that the need to analyze these are driving financial returns. And of course, this is beyond climate. The need, very importantly, to encompass the biosphere, ecosystem services, and nature as the balancing side to focusing on climate transition, adaptation and mitigation, but also societal challenges. Some challenges are still harder to determine within financial materiality. The data may be less available. The linkage to financial returns may be longer dated. But clearly, we're seeing short term that there are significant impacts. And I think balancing all these different areas of sustainability within financial analysis is a challenge. Trying to think that this is a science and an exact black and white exact way of looking at the world, when some of these topics are, do require forward-looking analysis, a lot of judgment into scenarios and expectations, and the linkage between both the society angle, the people and the planet, as well as financial prosperity can be quite hard. So within that, I just do want to focus a little bit on the regulatory environment. I don't want to go into too much detail here, but from an asset management point of view, one of the complexities currently is this alphabet soup of multiple different regulations globally, and many that are not speaking to each other, are not interoperable, expectations that are growing in Europe and the UK, significant focus on sustainable finance, significantly more reporting. I think the points really that stand out are the phasing in of some of the regulations, the fact that asset management community has been regulated ahead of the corporate disclosures. We're seeing a big significant shift there, and I think that's going to drive a lot more ability to really understand portfolios, as we will get a lot more consistency, availability of corporate data, which will make some of the disclosures significantly clearer. But of course, that still depends on the region of the world, There is extraterritoriality built into European regulations, but that some of the regulations elsewhere in the world are very much more, restricted, focused purely on climate, particularly in the US at the moment. But I think with the ISSB, the International Sustainability Standards Boards, we're beginning to see frameworks, baselines globally that are really helpful for structuring the direction of travel and will really give better remits. And the other area of focus that very much of importance is the need for regulation and the global regulation to build in transition finance. That for us is very important. It has been lacking to a certain degree in some of the European sustainable finance regulations to date. We're seeing it in the proposals from the UK, transition plans very clearly baked in. And I think it's very important to ensure that the finance can move in the right direction, that continues. I think we often hear about data and the need for more data and for sustainability. This little graphic here is really looking at, the fact that we don't just want data for the point of, we really want to have material data. The data needs to be, useful, decision useful. It needs to be sorted. It needs to be arranged. It needs to be specific to regions, to sectors, and very clearly presented such that clients can understand what that data is telling you about the investments in a portfolio. Because that data needs to tell a story. We don't just want data, as I said, for the sake of it. It needs to explain why we can invest in one particular company and not another company. So it needs to be decision useful. And I think it's very important to understand that, if you had a data point for one company in one region of the world, and the same data point for another in the same sector, but in a different region of the world, that might lead to very different investment outcomes. A steel company in Europe will need to have a very different transition trajectory to a steel company in Asia. And you've also got to bake in the policy environment and the support. That same steel company may be regulated under the emissions trading scheme in Europe. In the US, they may be getting support from the Inflation Reduction Act. And in Asia, there might be need to have an understanding of the phase out of the fossil fuel-based coal system, and thinking about, say, the JETP partnerships, the Just Energy Transition partnerships in Indonesia, and the impact that may have on the sector. So all of this information is really needed to be material. And then, of course, we all know that we're not currently on a transition trajectory that is moving towards 1.5 degrees. And the difference between 1.5 degrees and 2 degrees is incredibly stark. But when we're thinking about this in terms of investment portfolios, that difference is incredibly important to understand, because if we're analysing a company in the food sector, which is very reliant on crop yields, understanding whether those yields are going to be down 7% as a result of climate damage, or 3%, does make a significant difference to investment decisions. So that's why we need forward-looking data and scenario analysis that can really drive decisions that can be, look forward at the direction of travel. Equally, that difference between 1.5 and 2 degrees in a portfolio might see a shift from a focus on investments in climate mitigation in a 1.5 degrees scenario. In a 2 degree scenario, climate adaptation to climate damage might be significantly more important to be factored into the portfolio. And if we think about the opportunity set, clearly there are significant opportunities within sectors. We're seeing some policy support really shifting to drive those opportunities. More needs to be achieved, but it's really delivering, ramp up in the fuels that are needed, the renewable energy, this shift in the transportation system, all these areas which can really deliver investment portfolios. And that's very exciting to see, but does it require, real close understanding of the policy environment and what those impacts are. And I think I'll wrap up by speaking a little bit more about transition finance. I think we all know that currently, as I said, the 1.5 degrees isn't looking to be the most likely scenario. If we look at the data from MSCI, I think of all the listed companies out there are on track currently for a 2.7 degrees scenario. Therefore, if we are to align our portfolios to net zero, we're aligning to a scenario which isn't aligned to the real economy, and that is a real problem. It's a problem for any asset managers who've committed to net zero commitments and who are really wanting to drive real economy decarbonisation, because there is a significant difference between portfolio carbonisation, investing in low carbon solution providers, versus really driving real economy carbonisation. And seeing these sectors, the hard to abate sectors, the electricity sector, industrials, cement, buildings, the sectors that are absolutely vital for future economic growth, but which most urgently need to transition and which need the financing to transition. And for us, that's why it's incredibly important to build those into portfolios as long as companies have credible transition plans. I'm going to skip a few slides ahead. I think, looking regionally, it is very important to focus on exactly where the finance is most urgently needed. We know it's the hard to abate sectors, but also by regions, the sectors that, the countries which potentially don't have as much access to financing are the ones that most urgently need this financing. And we really urgently need that policy support to ensure that we can support the transition. And that's, how do we support the transition? There are a number of ways in portfolios to drive real economy decarbonisation. We need to look at transition plans on a forward-looking analysis, not just of where companies are today, and are they heavily carbon intensive today, but the direction of travel, both in terms of the medium term, including via engagement and advocacy is incredibly important, driving more policy support, as we know that the policy right now isn't strong enough to deliver net zero. There is the ability within our portfolios to really engage to deliver on that. And then over the longer term, ensuring that companies have transition plans in place. I will leave it there, but thank you very much for listening. Lots of other areas that we could have focused on, including impact investing, but that was a very whistle-stop tour of what are some of the challenges that we're facing today in the sustainable finance and particularly within the asset management industry.
Thank you very much, Kristina, for this insightful presentation. Let me now introduce without further delay the next speaker of the session, although I think that most people in the audience already know much about Professor George Skiadopoulos. Mr. Skiadopoulos is a professor of finance at the Department of Banking and Financial Management of the University of Piraeus and at the School of Economics and Finance of Queen Mary University of London. He's a co-founder and director of the Institute of Finance and Financial Regulation and an honorary senior visiting fellow at Piraeus Business School, City University of London. He's a member of the Group of Economic Advisors to the European Securities Markets Authority, ESMA, the supranational supervisor of European financial markets. His research interests and professional expertise lie in the field of asset management and asset pricing, climate finance and ESG, commodities and financial derivatives. He has published in leading academic journals, and he is a speaker at international conferences and seminars for academics and practitioners. He has acted as a consultant to a number of financial institutions. He has also served on the Academic Advisory Board of the Professional Risk Managers International Association, PRIMIA. Professor Skiadopoulos holds a PhD in Finance from the University of Warwick, a Master of Science in Mathematical Economics and Econometrics from the London School of Economics, and a Ptychion in Economics from the Athens University of Economics and Business. Professor, the floor is yours. Thank you.
Thank you very much, Mr. Chontoulidis. I'll spend the next 15 minutes presenting some thoughts, ESG thoughts, food for thought as I call it, but please shout at me as soon as I have 2 minutes left, Feel free to interrupt me,
Sure.
Rudy. Okay,
Thank
so my talk is going to focus on 4 points: whether the disagreement of ESG ratings is a real problem, whether ESG investments outperform, whether investors genuinely care about climate change risks, or are they forced to do so by regulators? And if they do care, which companies do they use to hedge these climate change risks? So regarding the first point, we all know by now that ESG ratings differ substantially across vendors. So this correlation of ESG ratings across vendors can be as low as about 55%, whereas if you think about correlations between credit ratings, these may exceed 95%. However, this disagreement is expected in a way. Why? Because there is no agreement on what it is to be measured when it comes to ESG. This is not the case with credit ratings. With credit ratings, we know that the object to be measured is the ability of the firm to repay its debt. With ESG, we do not know what the object is to be measured. So, for instance, when it comes to the social dimension, a rater may be using safety and health as a key dimension, whereas another rater may be using violation of benefit plans. So what does this mean for investors? This disagreement makes investors to work harder to identify the firm's ESG profile. Is this a real problem though? Well, if you think philosophically, this is consistent with the very nature of ESG. ESG is about diversity. So are the ESG ratings. And this disagreement is not new in finance. This is analogous to the case of analyst forecasts, where there is disagreement between their forecasts and between their research reports. However, this disagreement does cause 2 real problems in my view. The first problem is that ESG ratings are disconnected from the intentions of firms to improve. So think, for instance, as an example, the case of an energy company, which is rated to be brown. However, the same energy company may be a great innovator in terms of clean technology. The second problem is the incentive structure of ESG raters. So let's set the scenery here. ESG raters have clients. Who are the clients of ESG raters? Who are the guys who are going to buy these ratings? Well, the clients are the institutional investors. What is the motivation for an institutional investor to prefer the rating of vendor A rather than the rating of vendor B? Well, the motivation would be if rater A can convince the institutional investor that the ESG ratings that C produces will lead to, say, stock outperformance when they are integrated in their investment strategy. So this, as a result, causes a data mining. It is documented in a recent publication in the leading journal in finance, the Journal of Finance, that certain ESG raters are recomputing the ESG ratings in their backtesting tests, the internal backtesting tests. So, and they convert to the ESG rating, which is going to show a positive alpha, positive outperformance. This creates the following problem. The ESG rating is a data mined and does not really reflect the actual ESG profile of the firm. Speaking about outperformance, what do we mean when we talk about outperformance in finance? Well, outperformance is defined relative to a benchmark model. This brings up the concept of alpha. What is alpha? Alpha is the difference between the average return attained by the fund manager minus the average return of a benchmark. If this difference is positive, we call it an abnormal return, a positive alpha. A very famous example is Jensen's alpha, which is based on the capital asset pricing model. So Jensen's alpha is the difference between the average return attained by the fund manager minus the average return provided by the capital asset pricing model, which is the benchmark in our case. What is the caveat here? Well, the thing is that the choice of the benchmark model, as you can tell from this very simple example, is of crucial importance. Depending on the benchmark model one uses, you may have a different answer for your alpha. So if you have misspecified your benchmark model, in other words, if you are not using the correct model, you may report an ESG alpha, whereas the ESG alpha may not be there. So what is the question now? The question is, what kind of factors should we include in our benchmark model so that we compute alpha correctly? And factors related to the size of the firm and the quality of the firm should be included. Many times people forget to include these crucial factors. What is a quality firm? A quality firm is a firm which is highly profitable and at the same time it invests conservatively. So it is of crucial importance to include these factors in our benchmark model when it comes to computing alpha. Because if we do not, the ESG ratings and the ESG alpha may simply reflect the omitted factors which are related to the firm's characteristics. A very nice example is the case of the size of a firm. It is well documented that big firms, firms with a high market cap, typically enjoy high ESG ratings. Why is this happening? Well, this may not be a coincidence. Why? Because big firms have resources to do marketing, okay? And as a result, they can enjoy a high ESG rating. So from a practical perspective, one can use factors like profitability, investment quality, volatility, betting against beta factors in the benchmark model so that we have some faith in the estimated alpha. This echoes also the view of Professor Raskopal, who suggested to be very cautious when it comes to talking about ESG alphas. So what if there is no ESG alpha after all? Well, obviously, this is bad news for some players. Some players who base their selling, the selling of their products, on the narrative that if you buy my product, you are going to get a positive outperformance. The narrative should be modified. Doing well by doing good, well, we may not have both worlds. So we should mind the way that ESG products are marketed. So we should be very careful when we see labels like ESG leads to financial outperformance. However, the ESG criteria may still be beneficial, even if they do not lead to a stock outperformance. Why is that? Because they can make a positive impact to employees and the society. They can be consistent with investors' preferences, and they may be used, at least some of them, as we'll see in a minute, to hedge climate change risks. Related to these concepts, a key question is whether investors are genuinely interested in taking climate change risks into account. So on the one hand, we have patterns like, say, the UN Principles for Responsible Investors Network, which has grown immensely. And this may suggest that institutional investors do care about ESG and about climate change risks. However, in a recent study with Cheng Zhu, we have addressed a very simple question. Do institutional investors who invest in US care about firm-specific climate change risks? So we studied the relation of their portfolio holdings with certain climate change risks. And what we found is that their portfolio holdings are not affected by physical risks. Very strikingly, not even the insurance companies take physical risks into account. On the other hand, they are affected by regulatory and technological climate-related risks. More broadly, in a study with colleagues from the Bank of Denmark, we have provided first-time evidence on which types of market-wide climate change risks are reflected in US stock prices. What did we find? Guess what? Stock investors in US do not care about natural disasters and global warming. They do not care about international summits. They care about these risks only when the discussion reaches the Congress and the regulator intervenes. If you want just to visualize a bit the pattern, what I show to you here is how climate change risks affect the portfolio holdings of various types of institutional investors like banks, insurances, brokerage firms, mutual funds, and pension funds. The asterisks indicate that you have a statistical significance. The effect is statistically significant on the portfolio holdings. So when it comes to the total climate change risk exposures of the firms, they do affect the institutional investors' portfolio holdings. But if you dissect these climate change risk exposures in technological, regulatory, and physical, you see that the physical ones do not play any role, not even for the pension funds. So what kind of firms do investors use to hedge the regulatory risks? Well, the common belief would be that investors use green firms to hedge climate change risks. Actually, this is not the case. Brown firms may also be used by investors. Why is that? Because the intentions of the firms matter. It's not just the static picture given by an ESG rating. The investor is very much interested in knowing what is the intention of the firm going forward. Negative climate. 2 minutes. Thank you. Negative climate shocks stem from positive shocks to their outputs. So this renders them a good hedging vehicle. And what is green after all? The metric matters. So to give you an idea here you see 5 portfolios. Portfolio 5 contains the brown firms, and portfolio 1 is the portfolio which is used by investors to hedge these climate change risks. So you see here the ESG score of portfolio 5, which is relatively low. So this is the brown portfolio. But you see that portfolio 1, which is used to hedge these risks, also has a very low ESG rating. So this is again a brown portfolio. On the other hand, if you define green based on another metric, like for instance, the emissions, then you see here, for instance, that the brown portfolio is now hedged by a green portfolio. So to conclude, disagreement in ESG ratings, it may be inevitable after all. It is not novel in finance and certainly is not a sin. However, this raises key problems that the regulator can take care of, like the data mining and it misses the actual firm's intention. When it comes to ESG alpha, we have a high risk that the reported ESG alpha is simply greenwashing. Why is that? Because whoever publishes this ESG alpha may have forgotten some key factors to incorporate in the benchmark model. So the regulator needs to protect investors from ESG alpha greenwashing in the same way that a regulator should protect a non-ESG investor. So if you invest in a fund which says that it's conducting active investing and you pay a high fee for that, it may well be the case that this fund is not really an active fund, but simply a passive fund. So the regulator should also protect these investors. If you have no evidence for ESG alpha, this does not mean that you knock down ESG. It's just that the narrative needs to change. And finally, we know now that investors care about climate change risks only when the regulator steps in. This makes us revisit common beliefs on hedging instruments, but at the same time, it raises the question, is this policy intervention desirable? Does it cause distortions? There is a heated debate in the academic literature on this. And the risk is that if the regulator is not careful enough, she may throw the baby out with the bathwater. So you may be penalizing a brown firm, which, however, has started the process to become green by developing new technology. So that's all I had to say. Thank you very much for your time.
Thank you very much, Professor Skiadopoulos. Really mind-stimulating remarks, and I'm also looking forward to your comments during the QA session in the end. Now, moving on to the last speaker of the session, please allow me to introduce Mr. Kevin Flowers. Mr. Kevin Flowers is the Deputy Head of the Green Finance and Investment Units of DG Environment at the European Commission. The unit coordinates the work in DG Environment to ensure the integration of environmental requirements, investment needs, and policy considerations into other relevant EU policies and funding programs. As part of a broader cross-services commission team, the Green Finance team in the unit supports implementation of EU sustainable finance strategy, including work in relation to the Sustainable Finance Taxonomy, the Corporate Sustainability Reporting Directive, the Sustainable Finance Disclosure Regulation, natural capital accounting, environmental investment needs assessment, and the development of biodiversity ecosystem risk assessment frameworks for the financial sector. Mr. Flowers combines a background in natural science, economics, and finance, and business management. He has worked in both the public and private sectors, including 15 years as a senior partner at the Global Sustainability Management Consultancy, ERM, where he helped lead and grow the company's international sustainability strategy, performance and assurance, and mining sector teams. He's a guest lecturer at the Copenhagen Business School on the Master's Program for Corporate Responsibility, Governance and Communication, where he lectures on the connections between sustainability, business strategy, and risk management. Following this introduction, Mr. Flowers will now take us through his presentation.
Thank you very much. Can you hear me? Can you?
Yes.
Yeah, you can hear me.
Yes,
Let
very
me
well.
see if I can launch my screen. Not so obvious how you do this. Hold on, let me go back to, so I put this in this mode. It's just a question of getting it to the full screen. And I will try and make it full screen if that works. It doesn't, there we go. Is that clear? Can you see the presentation?
Yes, yes,
Good.
we have it in full
Thank you.
screen. Thank you.
All right, very good. Thank you. Well, first of all, hello from a very warm Brussels today. And thank you for this opportunity to participate in this very interesting and very topical discussion. What I'm going to try and do in my 15 minutes, and please also wave at me a minute or so before the end of my allocated time, I just give an overview of the state of play in the EU Sustainable Finance Policy Agenda, which has been moving at quite a pace over the last 2 or 3 years, as well as try and set it within a slightly wider strategic intervention logic. Why are we doing what we do? Does it make sense? I should add, by context and by I suppose a disclaimer, I work in DG Environment. We are not the lead part of the European Commission on these files. Of course, that is led by our colleagues in FISMA. But since much of the substance relies on environmental knowledge and policy input, we are obviously a very close partner with our colleagues in CLIMA and ENA and so on, working together with FISMA to develop this EU Sustainable Finance Policy Agenda. I would also add that when we talk about ESG, we are talking not just about climate when we refer to the E part. Clearly, we also need to be thinking about the other environmental objectives, particularly the nature biodiversity aspects, but also our objectives on water and air and circular economy. Our assessments and work on investment needs and gaps suggests that for Europe at least, of the approximate 600 billion gap that we have in investment for meeting our climate and environmental objectives, about 110 billion of that is related to meeting EU environmental objectives. So not as big, but still important. And I will focus, clearly there's an important part related to the social aspect of all this ESG, but I will focus the presentation. And I think much of the work so far done under the sustainable finance policy area has also focused more to the climate and environmental side of the equation, but not entirely. So by quick way of background and setting the context, whilst the devil is often in the details, I think it can be useful to take a step back for a moment and ask ourselves, what is it we're doing that is actually, and how does it drive impactful outcomes from what we're actually trying to achieve, which is, of course, climate mitigation, climate adaptation, and environmental footprint improvement. So moving towards sustainable, environmentally climate sustainable ways of doing things. The 2018 EU Sustainable Finance Action Plan was centered around 3 broad themes: mainstreaming sustainability into financial risk management, reorientating financial investments, so more from the investment logic, and doing so by defining sustainable investments, improving disclosures, and improving transparency. And then the last part is funding and financing the investment gaps and needs, and avoiding environmental harm from other investments, so the do no harm principle. And when you think about that from an actual climate environmental outcome perspective, impactfulness, the first two areas are more driving at an indirect effect by, for example, signaling to real economy companies the direction of travel that's going to be needed if they want to continue to court green investment, green financing, or green investment particularly at competitive rates. The one that actually has the most effect in terms of actually reducing climate and environmental footprints and risks is the funding and financing that companies need in order to transition and grow their businesses and business models into more sustainable and carbon neutral ways of doing things. So when we so another way of positioning this or showing this is to look at it from two simple angles. On the one side, improving the context around sustainable finance in terms of transparency, disclosure, labels and standards, so that we can better identify where there are harmful activities, so we can try and address the greenwashing, and perhaps most importantly is try and create this transition dynamic, this transition pressure. But and I can't find a better term for it, I'm sure there is, but what I tend to refer to as fresh financing, i.e. actual lending and access to financial capital that businesses need to make the CapEx investments, to make the OpEx investments, to make the changes in their business activities, or to grow more low footprint activities like renewable energies, which replace high footprint activities. This is the area that will certainly have probably the most catalytic effect in terms of driving the actual improvements that we seek from a sustainability point of view. So where are we today, given the actions driven by the 2018 action plan, where there's been quite a flurry of activity? My experience of being in this world, this domain, both on the policy and on the private sector side for now, I dread to say nearly 30 years, is that there are small windows of opportunity where the stars align and where we can suddenly actually move the needle forward quite a lot on sustainability related policy matters, and those stars did align with the European Green Deal, with the new Commission College that came in, and things moved rather quickly until we then ran into the COVID crisis and our energy and inflation crises. But so in that period, quite a lot was done, but most of it around the taxonomy, disclosure and classification side of things, and some work being done on the risk management, so helping the financial sector better integrate and mainstream climate and environment risk management considerations, exposure assessments, and so forth. The bit that has a gap in it at the moment.
But we seem to have two black boxes, blocking the view on your slide. I don't know if this is
they're not showing
on my screen or a broader problem. Yeah, it's like.
Is this the same on the previous slide?
Yes. It's a vertical and a horizontal box. I don't know if something.
That's very strange. I see it perfectly on my side.
Maybe if you can try to reshare.
Yeah.
Presentation maybe.
Yeah. Okay.
Yeah. Okay. It grew, so it's probably a Zoom object. Maybe you can minimize, or can you see minimization?
I'm trying. Let's see if we can make this work. Is this working? No, it's gone crazy now.
Not yet. I mean, it grows and then it goes back to the initial size that when I interrupted you. All right, now it's much smaller. Maybe if you can take it a bit further up.
Maybe I just go to the, let's see if this works. Does this work? I'm going to stop sharing.
Fortunately
Try
not.
reshare. Sorry, let me just try this again. How's that?
Unfortunately, they're still there. I don't know why.
I have no idea what to do. I'm simply doing, you know, what the screen sharing tab instructs me to do. I try stop sharing again. Let me try and close and open my presentation again. Let me escape from this, and let's maybe just try it in the, I'll just try something else so we can just go straight from the PowerPoint without loading the big screen. And I come back to you, hold on, share the screen. Here we go. How about this?
Well, yeah, the one on the top now. If you leave it there, it doesn't block. There is one on the side which is vertical. If that could.
That one's showing, but the main one is not.
Yeah, I mean, now we can marginally see the content. I don't know the next slides if it will be blocked. Maybe.
Oh, that's bizarre. Okay, so if I do this, how does that? Are you able to see now? Is that the side that you're seeing?
Yeah, on that side is fine. It's a bit small
Yeah, it's
for people
tiny.
to notice, but let's go through the presentation and maybe this helps a bit. I'm not sure. Yeah,
I apologize. I don't know what's. I mean, I just have the PowerPoint open in a normal fashion. All right, look. I'll talk it through, and then hopefully something can be visible from the slides. What I was on my way to saying was that, as you can see, hopefully somehow in that tiny box, we have not got a lot of action yet on transition financing. And I'll come back to that in a minute. So what we do have now is quite a comprehensive disclosures regime. So we have the CSRD that's coming with the standards, hopefully to be adopted in a short space of time. The first set of standards. Obviously, we have the SFDR and we have the taxonomy. So the question is then, what next? Where do we go with the sustainable finance policy agenda at the EU level? And this has to a large extent been captured in the 2021 renewed sustainable finance strategy, the strategy that was released in July 21, where the focus, clearly a large part of the focus is actually, now that we have all these pieces, is to start looking at them from a usability and a coherence and an alignment perspective. So that will certainly be part of the Commission's focus over the next 2 or 3 years. But we also need to start looking a bit more directly and specifically at this area of transition financing and what can be done from a policy perspective to support this, as well as continuing to support the mainstreaming of risk management into the sector as best we can in a way that is useful and needed. So the renewed sustainable finance strategy, which let me remember the full name. It has a name that exactly captures the fact that we're talking. It's got a focus on transition finance. It's the strategy for financing transition to a sustainable economy, and as well as elements on inclusiveness and the global ambition and building resilience contribution. There's a major piece here about financing the transition to sustainability. So upcoming elements, we have a package that is due to be adopted. One should never promise anything in the Commission until it's actually there, but all indications are that we should have a package, an updated sustainable finance package adopted this month, or next month, in June, which will include a chapeau communication explaining the new package. a focus on usability through a staff working document, and a recommendation on transition finance, as well as the hopefully much anticipated Environment Delegated Acts, the so-called Taxo 4 Delegated Act, and the update extension to the Climate Delegated Act under the taxonomy. That will also require an update of the Disclosures Delegated Act, Article 8 under the taxonomy, since the templates at the moment, the reporting disclosure templates are orientated to the Climate Delegated Act, but they will need to be extended to the environment. And we have the ESG ratings regulation proposal, hopefully coming then. Likely a little delayed, but hopefully still delivered, will be the first batch of reporting standards under the CSRD. In the longer term, there is the announced SFRD comprehensive review. Hopefully, some adjustments to the benchmarks regulation to take account of ESG factors. We're working actively to look at how the policymaking side can best support the mainstreaming of biodiversity and nature risk assessment into the financial sector. And as a second phase under the CSRD, there will be the sector-specific SME and non-EU reporting standards coming in the next year or two. So that's essentially the current sort of dynamic and focus of the EU's sustainable finance policy agenda. I won't go through these for the sake of time. Essentially, these are just some of the details on this Sustainable Finance Disclosure Regulation review to look at issues to make sure the legal certainty and the usability and its effectiveness in tackling greenwash is actually happening. We've had obviously quite a bit of feedback from the market. It's well noted, and it deserves attention, in addition to what's already been done by the European supervisory authorities in the short term.
Maybe a minute more, Mr. Flowers, to...
Yeah, okay, fine. So the recommendation on transition finance will be looking at how essentially to use the existing tools and mechanisms to identify meaningful transition finance opportunities. That will come, and there will be plenty of reading to do there. Just to note that whilst the taxonomy sets out criteria that are essentially the endpoint where you want to get to, or at least a substantial contribution endpoint. So it has a kind of logic that says this is green if you are operating at this level of performance. But it's because it's set at an activity level and not at a company or entity level, there is an inherent dynamic to drive a transition towards improved performance by slowly greening and improving performance of individual activities that you have responsibility for in your entity. Last but not least, I realize I'm talking ever more quickly to get it all in. There is an important aspect about operationalizing the do no significant harm principle, both on the private financial sector, as we already see in the EU taxonomy, and to some extent, well, it's touched upon in the SFDR, but it probably needs a little bit more better defining that. And then, of course, it's been used as a reference point for much of the EU public funding. So, as we've seen under the next gen EU fund, the RRPs, and it's being looked at under the other funding programs. So finally, if we are successful in our outcomes, we will have transition finance flowing to where it is needed. The negatives are understood, identified, and being addressed. So we move away from environmentally harmful funding. Financial market stability is taken care of. And the financial sector has the enabling frameworks and conditions to do this. So good data, transparency, coherence, technical support, and so forth. I can't see the bit on the right, but I know that it's the socioeconomic enabling frameworks and conditions. So we need the social fairness, the price signals, and the right socioeconomic models. And on the supporting side, we need really good, we need improved investment needs and gap analysis. A lot of good work done on the climate side. More needs to be done for meeting our environmental objectives, so that it's at a sufficiently granular level, sectoral level, member state level, to know where the transition needs are, financing needs are. And that implies also a good understanding of transition pathways. That's it. I'll wrap it up right there. I apologize for the slide miniature scale. I don't know what's going wrong, but
yeah.
hopefully.
Thank you. Thank you very much for your presentation. I mean, despite the technical difficulties, it was very interesting to hear views from someone who has worked for so many years in the industry before moving to the official sector. Let us move now to the Q&A part of the session. We have 6 minutes, unfortunately, but hopefully we'll manage to cover some of the questions posted. It's mostly addressed to Kevin and Catherine. It says, we're running to catch up with ourselves. However, we have concerns that we will be ill-prepared for those industries of the future, like space exploration, deep sea mining, robotics, and not only for ethical decision-making, but also for minerals, metals, environmental aspects that these industries require. Should we be designing the guidelines framework for performance in these areas now? I don't know, Mr. Flowers maybe could comment on that first.
Well, I mean, I think the short answer is yes, of course, and that is, a strong motivator behind the net zero industrial act that the Commission has just announced. It's not the sustainable finance framework as it's being designed is not being done in a way that would set standards that would make it impossible to move forward in those sectors. So if those sectors have important contributions to make, either in a positive sense or in a sense of they have negative footprints that can be and should be addressed, they will eventually be brought into the framework. At the moment, we've focused on activities that are most evident and can be addressed in a first phase. I mean, there's a certain capacity limit for the expert panel under the sustainable finance platform in terms of how many activities they can treat at once. So there's still a long list of additional activities that will be, for which criteria will be developed for the taxonomy, for example. And it's clear that in setting criteria, we are paying careful attention that we don't do it in a way that would inadvertently constrain the sorts of technologies and industries that are needed in order to get through our sustainability transitions. If that was the question, it was a bit garbled at the beginning. I'm sorry, I had bad audio, but I think that was the question if I caught the second half of it.
No, I think you covered it. And maybe, questions kept popping up in the last minutes of the session, and trying to go through and allocate them properly. Maybe Kristina, there is a question that is addressed to you solely, so maybe I can bring it to you. Regulation poses a significant bureaucratic burden on banks and firms. Is the game worth the candle?
Yes, overall, I mean, I think regulation is a burden, but it's also an opportunity. I think there are, we're seeing a move in the right direction. As we heard from Kevin, there is a, integration increasingly of transition finance into the regulatory environment. What we need very urgently is to see some kind of consistency in regulation and definitely interoperability globally. That is, we are spending a lot of time currently in the asset management and in the banking industry dealing with regulation. It is very costly. And there is an element where we are not innovating as much as we might be if we weren't so constrained. But I do think it is necessary to have those frameworks in place as long as the regulation is structured in a way that really does drive opportunities. And we're seeing it moving in that direction. It's not there yet, but this is a very intricate area and complex. We certainly want to see a focus on transitioning. We do believe that that's where there is a lack currently, and where, in order to ensure that the finance is moving to the right regions and the right sectors, that transitioning element is vital.
Thank you. Thank you very much. I can also see a question for the professor. Not sure we have the time to really respond, but I will give it a try. How have you quantified the climate change risks that you used in your studies?
Thank you. Thanks for the question. Very briefly, we have quantified the climate change risks by using machine learning techniques. in particular textual analysis of Reuters news. And we have used also variables constructed from other authors who have also used machine learning techniques which are applied to conference calls of the various firms.
Thank you. Thank you very much, Professor. And conscious of time, I think I will need to wrap this up. Thank you very much, all the speakers in the sessions, and handling back to you for the next steps of the event. Thank you very much.
Thank you, Mr. Chontoulidis, and many thanks to Kevin and Kristina. Thank you very much for joining.